week on WealthTrack, extreme investing with great investor Ken Heebner. Capital Growth Management's legendary portfolio manager has reached performance peaks and plunged to valley lows over the years. What investments is he scaling now? Find out next on Consuelo Mack WealthTrack.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value. Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. The bulls are back. U.S. equity funds posted their biggest quarterly inflows in 9 years in the first 3 months of this year. According to TrimTab's investment research, $52 billion flowed into U.S. stock mutual funds and ETFs. To put that into context, investors withdrew a total of $87 billion from U.S. stock funds in all of last year. But the renewed interest comes with a twist. Investors are favoring exchange-traded funds, the bulk of which represent passive index funds, over the most actively managed mutual funds. Over the past year, U.S. equity ETFs saw $80 billion in net inflows, while U.S. stock mutual funds experienced outflows of $120 billion. Investors are voting against active managers because they've done so poorly over the last decade. According to Investment News, only 38% of large-cap managers beat the S&P 500 over the last 10 years. Only 31% beat the market over the last 5 years, and only 18% did so in the past 3 years. And a tiny 9% of large-cap managers beat the market in all 3 periods. Well, this week's guest is a legendary and active mutual fund manager. He is Ken Heebner, co-founder and portfolio manager at Capital Growth Management, where he runs 3 mutual funds, CGM Mutual, Realty, and Focus. Heebner is known for his concentrated holdings, aggressive bets, high turnover, and extreme performance, both on the upside and downside. He reached rock star status among investment professionals with CGM Focus, which was the #1 U.S. stock mutual fund for the decade ending in 2007. A dramatic decline in 2008 and a subsequent 5-year underperformance has caused an investor exodus, but his 10 and 15-year track records are far superior to the markets and put him in the top 1% of his peers. He won't discuss his fund specifically, but he has strong views on the markets and investing. I began the interview by asking him why he believes this is an exceptional opportunity for investing in U.S. stocks.
The United States economy has considerable excess capacity. The economy has been growing at about 2%. I think that growth rate is going to accelerate, and we can grow for several years. I furthermore think that when you look at the huge pool of global wealth that's been created after the Soviet Union collapsed and billions of people became highly productive, we've created global wealth that's searching for a place to invest. And today, looking around the world, the economies of Europe are declining. There's questions about what kind of growth Japan can continue to do. But in the United States, the growth is going to get stronger because of the positive impact of rising house prices on an economy that tends to grow anyway unless it's faced with terrible obstacles, of which I do not see one right now.
Why do you think housing is going to be stronger than the consensus believes?
I think we have a significant shortage of housing in the United States today. We had a surplus in 2005, but as housing starts collapsed, we brought production of new houses down to a level far below the annual growth in demand from population. And as a result of that, we have a shortage, and the housing industry is cut back capacity severely. That you have it not only in terms of less labor now than they had, but additionally, The housing industry takes years to entitle land, develop it into lots, put in the infrastructure, and then start to build houses. And as a result of that, the housing industry is going to be constrained in its ability to meet demand. Today, if you think housing formations are 1 or 2, 3 million, 2 or 1.3 million a year, and housing starts are at 900,000, we're way below the annual growth in demand. So the shortage is getting more intense every year. The result of this is going to be rising prices. In a lot of parts of the country, housing prices are down 25 to 50%. The arithmetic is, if we're going back where we were, they have to go up 50 to 100%. And that's going to happen sooner rather than later, in my opinion. But the impact of this is going to be that the balance sheets of people are going to improve. A lot less people will have their house underwater in 3 years from now. Additionally, a lot of people are going to have significant appreciation in the value of their biggest asset. The consequence is going to be a big increase in consumer confidence and financial strength and ability to spend. And the consumer is going to surprise on the upside in the next several years. We're starting from a growth rate of 2 to 3%, depending which economist you talk to.
Right.
It could be 4, it could be 5. And that is going to be a magnet for this huge pool of global money.
So U.S. stocks in particular, I mean, we've had, 100% plus gains in the stock market since the March '09 lows. We have new records being hit by the S&P and the Dow. So I mean, how much more upside is there left in the U.S. stock market?
When you talk about how much it's up, the starting point was 680 on the S&P 500, which was the lowest it had been since the Depression, practically. Therefore, that's a really low base. The fact of the matter is, if earnings grow for several years at a 10 or 15% rate, the PE ratio could go up a certain amount. You could see the stock market 2 or 3 years from now 50% higher. Now, that's not a huge number, and who knows, when you have something driven by a huge pool of global wealth, and you can perceive strong forces pushing a market higher, it's hard to know how high that could be. Maybe the stock market will get too high 4 years from now, but I'll deal with that problem when it happens.
One of the things that you're also known for is identifying big themes. And so one of your big themes then is this housing, resurgence in housing, right?
I think it's the single most important factor causing economic activity and the stock market to surprise on the upside.
So what are some of the other big investment themes that you're tracking?
We have consolidation in industries in America, and it varies in terms of its importance, but we're talking airlines, rent-a-cars. These are industries where there are a lot fewer companies doing the same thing, and that means that margins are going to be higher. Corporate profits are benefiting from very strong productivity growth and low inflation on the labor front. So these are all forces causing profit margins to stay high and go higher than they've been.
Now, another industry that you and I had talked about earlier that has gone through a massive restructuring is the banking industry. And you were actually positive about the U.S. banking industry?
Now, here is one where the market has not recognized in the big global banks the very positive changes. What you read in the newspaper is the regulators don't like these companies, they're after them, the plaintiffs' attorneys are ganging up on them, there's tens of billions of dollars of settled claims and future claims against these companies.
All true.
It's all true. But when you look at the PE ratios of these big banks, they are well below where they've ever been. Not ever been, but they're off of the lows, but they're low by historical standards. They are big beneficiaries of the problems in Europe. They compete with the European banks, which have serious problems, which are remaining which remain operative. So there's market share opportunities. And in the banking industry, we now have 5 banks with the 5 biggest banks have about 50% of the deposits. That's a level of consolidation we've never seen before. So that you've got a much better profit outlook, and you also have low PE ratios. Now, additionally, the regulators have been demanding. But what the regulators have wanted to do was build fortress balance sheets. And they've been taking measures against the banks to against the shareholders of the banks to cause the banks to build up equity. Well, they've done that. The equity, the ratios of the banks are getting to levels where the regulators might not let the banks go crazy in terms of activities, but they're going to relax the level of restraint, so that business opportunities are stronger than they've been. The pricing power is going to be stronger than it's been for the banks, and the regulators, they're not going to be generous to the banks, but they'll be less harsh.
So interesting. So we're talking about Citigroup, and we're talking about J.P. Morgan Chase, and we're talking about Wells Fargo, Bank of America, the big banks that you think that everyone is completely discredited. You think there's opportunity
And I throw
there.
Morgan Stanley in.
Okay.
And Goldman Sachs.
Goldman Sachs.
Now, admittedly, Goldman Sachs is opaque because they don't really tell us how they make their money. So on that one, you've just got to figure they're as smart as they've always been, and they won't tell us any more about how they make their money than they did 3 or 4 years ago, but that they'll keep doing what they've always done. In the case of Morgan Stanley, you have a company which has focused on wealth management and which was able to buy Solomon Smith Barney from Citigroup when the regulators were pressuring Citigroup to strengthen its balance sheet on extremely favorable terms. And this is a business which commands a 20 PE in general, asset management. Whereas I don't think the global banking business, because of all the issues, well, it doesn't have that high a PE. But now half the revenues of Morgan Stanley come from wealth management. So you're not only going to see surprising earnings, but you're also going to see potential for a very substantial PE upgrade. And people don't like to come. They say
They sure don't.
And it may be that Mr. Gorman does not have the most winning personality. I don't know, but I think he's a very smart guy, and I think he's making all the right moves, and he's focused on the shareholder.
You have a very high turnover in your portfolios at Capital Growth Management. So how do you as an investor reconcile these long-term trends that you're seeing with your very distinctive style of rapid fire trading?
Well, in terms of individual stocks, I have a very aggressive sell discipline. If a company does not meet my expectations, it gets sold
Quickly.
But there are companies that perform and they stay in the portfolio. So in reality, a portion of the portfolio is turning over faster than the average, and there's not a lot of stocks, but some of the stocks, the ones that really turn out to surprise me on the upside. When I buy a stock, it never works exactly as I think. Either it gets better or worse. But the ones that get worse go out, and there's a few that get so much better that they stay there for a number of years.
That's so interesting because, a number of people that I've talked to before I interviewed you said, and we've asked them, what's the question that you want to ask, Ken Heebner? And one of the questions is, how does he describe his investment style?
I look for situations where I think the fundamentals are a lot better than everybody else thinks they are. I wish there were more of them. I'd say the big investment banks are in that category today. If you ask me about home builders, it's a more mixed picture because the stocks are way off their lows. There has been acceptance of the idea in the investment community that the home building industry is going to have strong volume growth and strong pricing over the next several years. But here, I think that the results are going to be much stronger than people think. People are looking at what the gross margins were at the top, and I think those gross margins are going to be exceeded because the supply-demand relationships in this business for new homes are going to be far stronger in the next several years than they were at the peak of the bubble. That doesn't mean we'll be producing more houses. We won't get to that level of production. But the imbalances in supply and demand are so substantial, and the consolidation in the home building industry is significant enough that the pricing power of the home builders will be far stronger in the next several years than it was at the peak of the bubble, and therefore higher margins. And the margins were 25% back then. That's not, if you look around business where there's a tight supply-demand relationship, 25% is a low gross margin for that kind of environment.
How do you view the airline industry, which Warren Buffett said he won't ever touch again, but we've seen tremendous consolidation?
Now, the airline industry that's a very interesting question. 6 months ago, I would have told you people don't believe that the consolidation is going to benefit this industry. Well, in December, in Boston, when you're having a dinner for investors, people don't want to come out. Well, in December, I went to a dinner, and there were a dozen people there, and all the biggest investment companies. This is for an airline analyst, and all the biggest investment companies are represented there. And I said, well, gosh, this is not an industry that people are skeptical about. So I have mixed feelings toward the airline industry today. I think there has been huge consolidation, and I think it is a better business. But the crowd seems to see that, so it's a toughie. But basically, the view that the airline industry is attractive because of the consolidation is not a contrarian view. So that takes some of the juice out of the argument for me. I mean, but if you said that about a big bank, no, people don't want to own those.
So no one's going to the bank analyst meetings.
Yeah, I haven't been to any dinners for banks. And if I go to one, I'll say, well, I don't know. I know too many people agree with me. I'm getting nervous.
So the Heebner indicator is, what the attendance is at an
well, I wouldn't
analyst.
put it that way. There's a lot more to it than that.
Yeah,
but like what this one firm is telling me, well, people are getting comfortable with the idea of owning airlines. The generalists are asking questions of the analysts. Normally, we just get the airline analysts at the big buy-side companies. Now, the generalists are asking questions. And I don't like to hear that.
So let me ask you about another characteristic that you're known for, and that is having a very concentrated portfolio. So and you've been investing like that for a long time. Instead of being broadly diversified like a lot of other money managers are, you really are focused. So why is that? What led you to that?
I look at the risk-reward ratio. I look at all the things we're talking about. And all situations are not created equal. Usually, there's a half a dozen or 10 that stand out, where the risk-reward is really stacked in favor of the buyer. And they're the ones I want in my portfolio. There's another 20 or 30 or 40 that I want to own, but it's the fact that there often are some really exceptional risk-reward ratios out there when I look at it. And so I want to give those as much of a weight in the portfolio as I can. And so that's why I concentrate. When I first started out as an assistant portfolio manager in 1973, they handed me a portfolio with 70 stocks. And I said, well, as I studied them, and I could see that a couple of them looked really good, and the others weren't as good. So why hold the ones that aren't as good? Now, the side effect is volatility that exceeds everybody else's portfolio. And if someone wants to be close to the market for a month or a quarter in their performance, my portfolios, they don't want to get anywhere near my portfolios. And you can't, and and you get short-term performance, or even for a year or two at a time, which is so out of sync with everybody else's portfolio that people say there's something different here and I don't like it. But I believe it creates the greatest long-term opportunity.
Because it's so interesting, is that somebody described you as your performance, which has been extraordinary over the years, as extreme performance. So looking at the financial crisis, for instance, were there anything lessons that you learned from the financial crisis in running portfolios?
But there is a very interesting case, because my portfolios were heavily concentrated in commodity-oriented stocks. When I took those positions, for instance, when I believed in the early 00s that the price of oil was going to go over 30 and keep going, no one agreed with me. But by the time we got to 07, people thought it was going, well, in July of 08, Goldman Sachs came out and said the price of oil is going, and they recommended oil stocks with a price at 147.
Right.
Goldman Sachs had a dinner, and there were 25 people there to hear why the oil price was a buy at 147. So I should have come back from that dinner and said, wait a minute, I should get nervous here because too many people agree with me.
So what are you nervous about right now? It's the bond market, right, that
That's
you
right.
think is very dangerous.
I would guess that if somehow you could have a dinner for people about bonds, you'd have 100 people at the dinner. The problem for bonds is that interest rates have been driven to the current level by fears of weak economic activity, which I think are unfounded, and the buying of the central banks around the world. The United States has been doing it heavily. They've never done it. Our government has never been a massive buyer of bonds in the last 50 years the way they are today. Now the Japanese are doing it. The ECB has talked about it in conditional terms and bought some sovereign bonds. However, global economic activity is going to be growing, inflation is rising, and the way to look at bonds is should be a 300%, a 3 percentage point premium over the long term. The risk-free bond should sell at 300 basis points above the inflation rate. Well, I think the inflation rate globally is 1 or 2%. It's going higher. So long-term, 30-year bonds ought to yield 4 to 5%.
And you're known for taking a big short position against the 30-year Treasury bond.
I have shorted the 30-year Treasury, but first point I want to make is, in no way do I have any hesitation about the credit of the United States of America. I think our country's got a great future, and I think we're going to solve our fiscal problems. I believe that that with inflation moving up from a 2% level, the bond should yield 5% or more. If it yields 3 or less, I think the price of the bond is going to decline, and it's going to decline far more than the coupon of 3%. Now, when is this going to happen? To the extent that when you get these excesses and these bubbles, the timing is very hard, and it's very painful because they keep going up in your face. If you're short something, it goes up in your face. But I think when the reward comes, it'll be very substantial.
It's going to be very substantial if you're shorting. It's going to hurt a lot if you're long bonds, which a lot of investors are.
Right. And investors tend to be very comfortable buying something that's been going up in price, that's given them a successful experience. And the bond, I remember when Treasury bonds yielded 15% in 1981.
And no one wanted to get near them.
And I was recommending Treasury bonds in 1981. And I remember being called in to the board of trustees that had their law firm, and they were debating whether buying these bonds at 15% yield was too risky to put in a fund. And they ultimately let me do it. But here we are, and the long-term bond yield's less than 3. And I think that the investors who've had a great experience in the bond market have been buying bonds, among other reasons, because they've had a great total return experience, driven by price as well as coupon. And when the price starts to go down and they start to look at losses, they're going to exit. So I think that bonds are a bad place to be, and I think that money is going to go into stocks.
We'll leave it there. Ken Heebner from Capital Growth Management, thank you so much for joining us on WealthTrack.
Thank you.
At the conclusion of every WealthTrack, we give you one suggestion to help you build and protect your wealth over the long term. This week's action point is make sure you and your investments match in substance, style, and personality. Over the years, we have covered the distressing difference between how mutual funds perform and the poorer results investors in those same funds get. We call it the underperformance gap. It's not just fees, trading costs, and taxes that explain the difference. A huge factor is investor behavior. Ken Heebner's CGM Focus Fund is a classic example. Over the last decade, the fund delivered impressive double-digit annualized returns, outpacing the market. But according to Morningstar's calculations, investors in the fund had a far less positive experience, a big underperformance gap. Investors poured into the fund after one of its fantastic winning streaks and then bailed out in droves after its dramatic decline in 2008. Thus, investors completely missed the great long-term performance. The moral of this story is if you can't take the heat, stay out of the kitchen. And before you invest, make sure a fund's personality matches your own. Well, next week, we're going to talk to someone we think is a next-generation financial thought leader. We have a rare interview with Ben Inker, co-head of asset allocation at investment management firm GMO. If you missed any of our past great investor or financial thought leader guests, you can find them on our website, WealthTrack.com, and get some personal insights into what makes them tick in our WealthTrack Extra feature. In the meantime, thank you so much for visiting with us. Have a great week and make it a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.